CVP analysis rests on a handful of simplifying assumptions that let us use straight-line math instead of complex curves. Linear cost behavior. Variable costs change in direct proportion to the number of units produced. Fixed costs stay constant regardless of output within the relevant range. Linear revenue behavior. The selling price per unit is constant, so total revenue is a straight-line price times quantity. Single period horizon. The analysis looks at one planning period. Cost structures are assumed not to shift during that time. Relevant range. All relationships hold only for the range of activity where the company's current plant equipment and personnel can handle production without major changes. All produced units are sold. No inventory buildup or shortage is considered. What you make, you sell. No mix changes for single product analysis. The product mix is assumed constant, so the per unit contribution margin does not vary. Contribution margin concept and formula. The contribution margin, CM, tells you how much each unit sold contributes to covering fixed costs and then to profit. Unit contribution margin, UCM, equals selling price per unit P minus variable cost per unit V. Analogy: think of each product as a pizza slice. The price you charge is the slice's size, the variable cost is the dough and toppings for that slice. Whatever is left after paying for the ingredients helps pay for the restaurant's rent, fixed cost, and finally adds to profit. Total contribution margin equals UCM times quantity sold, Q. Contribution margin ratio, CMR, equals UCM divided by P, which is P minus V divided by P. The ratio shows the percentage of each sales dollar that goes toward fixed costs and profit. Formula summary. CM equals P minus V times Q. CMR equals P minus V divided by P. A small bakery sells custom cupcakes for $4 each. Variable cost per cupcake, ingredients, packaging, is $1.50. Monthly fixed costs, rent, salaries, utilities, total $12,000. Compute unit contribution margin. UCM equals $4.00 minus $1.50 equals $2.50 per cupcake. Break-even volume units. Break-even Q equals fixed costs divided by UCM equals $12,000 divided by $2.50 equals 4,800 cupcakes. Break-even sales dollars. Break-even sales equals Q times price equals 4,800 times $4 equals $19,200. The bakery must sell 4,800 cupcakes each month or earn $19,200 in sales before it starts making profit. Any sales beyond that point generate net income equal to the excess contribution margin. Goal: the same bakery wants to earn a target profit of $5,000 per month. Step-up method adds the desired profit to fixed costs before dividing by the contribution margin. Required contribution equals fixed costs plus target profit equals $12,000 plus $5,000 equals $17,000. Target volume units equals required contribution divided by UCM equals $17,000 divided by 2.5 equals 6,800 cupcakes. Target sales equals 6,800 times $4 equals $27,200. So to hit the $5,000 profit goal, the bakery must sell 6,800 cupcakes, which is 2,000 cupcakes, or $8,000 above the break-even level. The step-up method visually steps up the break-even line to the profit line. Alternative using profit equation. Profit equals P minus V times Q minus fixed. Solving for Q when profit equals $5,000 yields the same 6,800 units, confirming the method. Margin of safety MOS measures how much sales can fall before the company hits the break-even point. MOS units equals actual sales units minus break-even units. MOS percent equals MOS units divided by actual sales units times 100. Operating leverage shows how a percent change in sales affects operating profit. Degree of operating leverage DOL equals contribution margin divided by net operating income at a given sales level. Example: the bakery actually sells 8,000 cupcakes per month. MOS units equals 8,000 minus 4,800 equals 3,200 cupcakes. MOS percent equals 3,200 divided by 8,000 times 100 equals 40%. The bakery could afford a 40% drop in sales before losing money. Operating income equals UCM times Q minus fixed equals $2.50 times 8,000 minus $12,000 equals $20,000 minus $12,000 equals $8,000. DOL equals total contribution divided by operating income equals $20,000 divided by $8,000 equals 2.5. A 10% increase in sales would increase operating profit by about 25%, 10% times 2.5. These metrics help managers understand risk MOS and reward leverage of operating decisions. A CVP graph plots costs and revenues against output volume. X-axis : quantity of units Q. Y-axis : dollars costs or revenue. Total fixed cost line : horizontal line at fixed cost level does not change with Q. Total variable cost line starts at the origin and rises with slope equal to variable cost per unit V. Total cost line : sum of fixed plus variable lines. It starts at fixed cost on the y-axis and has the same slope as the variable cost line. Total revenue line starts at the origin, slope equal to selling price per unit P. Break-even point : intersection of total revenue and total cost lines. The x-coordinate gives break-even units, the y-coordinate gives break-even sales dollars. Profit area : region above the total cost line, and below the revenue line to the right of break-even indicates profit. Loss area : region below the revenue line, and above the cost line to the left of break-even indicates loss. Interpretation: moving the revenue line upward higher price, or the cost line downward lower fixed variable costs shifts the break-even point leftward, meaning fewer sales are needed to be profitable. The graph turns abstract formulas into a visual balance scale. When a company sells several products each with its own contribution margin, we use a weighted average contribution margin based on the sales mix. Example: a tech firm sells 2 gadgets. Gadget A price $100 variable, costs $60 unit contribution, margin equals $40. Gadget B price $150 variable cost, $90 unit contribution, margin equals $60. Assumed sales mix: 3 units of A for every 2 units of B, i.e. 60%, a 40% B by volume. Calculate weighted average contribution margin. Weighted average contribution margin equals unit contribution margin A times percent A plus unit contribution margin B times percent B equals $40 times 0.6 plus $60 times 0.4 equals $24 plus $24 equals $48. Fixed costs $240,000 per year. Break-even units in mix equivalent terms: quantity at break-even equals fixed costs divided by weighted average contribution margin equals 240,000 divided by 48 equals 5,000 mix equivalent units. Translate to actual units: Gadget A units equal 5,000 times 0.6 equals 3,000 units. Gadget B units equal 5,000 times 0.4 equals 2,000 units. Break-even sales dollars: A sales equal 3,000 times $100 equals $300,000. B sales equal 2,000 times $150 equals $300,000. Total equals $600,000. Thus, by using weighted average contribution margin, the firm can quickly compute break-even without handling each product separately, provided the sales mix stays constant. Key point: if the mix changes, the weighted average contribution margin must be recomputed. The analysis is sensitive to mix shifts. Sensitivity analysis asks, how does the break-even point or profit change when one input varies? Scenario analysis looks at a combination of changes: best case, worst case, most likely. Base case: use the bakery numbers from earlier, price $4, variable cost $1.50, fixed $12,000, target sales 8,000 cupcakes. Price sensitivity: increase price to $4.50, 30-cent rise. New UCM equals $4.50 minus $1.50 equals $3. New break-even Q equals $12,000 divided by $3 equals 4,000 units, down from 4,800. Profit at 8,000 units equals $3 times 8,000 minus $12,000 equals $12,000 instead of $8,000. Variable cost sensitivity, variable cost rises to $2. UCM equals $4 minus $2 equals $2. Break-even Q equals $12,000 divided by $2 equals 6,000 units, up. Profit at 8,000 units equals $2 times 8,000 minus $12,000 equals $4,000, down. Fixed cost sensitivity, fixed cost rises to $15,000. Break-even Q equals $15,000 divided by $2.50 equals 6,000 units. Profit at 8,000 units equals $2.50 times 8,000 minus $15,000 equals $5,000. Combined scenario, best case, price $4.50, variable cost $1.30, fixed $11,000. UCM equals $4.50 minus $1.30 equals $3.20. Break-even Q equals $11,000 divided by $3.20, approximately 3,438 units. Profit at 8,000 units equals $3.20 times 8,000 minus $11,000 equals $14,600. Combined scenario, worst case, price $3.80, variable cost $1.80, fixed $14,000. UCM equals $3.80 minus $1.80 equals $2. Break-even Q equals $14,000 divided by $2 equals 7,000 units. Profit at 8,000 units equals $2 times 8,000 minus $14,000 equals $2,000. Takeaway: small shifts in price or cost can move the break-even point dramatically. Managers use sensitivity tables